conversation with the pioneer of technical analysis in India, only on ET Now.
Welcome back. Well, let's focus on that one thing that goes very high when markets suddenly collapse, and I'm talking about volatility. Basically, the options start to price in a very high degree of risk in the price, and that's what volatility measures. So let's look at a very simple example. Let's just imagine a stock, say, trading at 100 rupees, and you pay a premium of 5% to buy a 1 month put with a strike price of 100. So it's a 100 rupees stock. You want to buy a put also at 100 rupees, you're paying a premium of 5%. Now, if the markets at this point suddenly become volatile, that same premium for the same prices may go up to, say, 8 to 9%. It's gone from 5% all the way up to 9%. Now, there has to be some way to trade this so you can make money on it. Doc, does this work?
Yes, it certainly does work, because implied volatility is one of the main ways that we use to price options and to trade options. Now, the rule of the thumb is that IVs will actually help the price of options. If IVs rise, the price of options rise, right? So anybody who's looking to buy an option must first also have a view alongside on the view on the IV, how it will actually trend. IV stands for implied volatility. Now let me show you a concrete example using a chart of the 4900 put. Now the 4900 put is something I'm using deliberately, because at the end of July we were trading well above 5,000, and 4900 put at that point of time would be what we consider as an out of the money put, meaning it's away from whatever the market is trading. But what is interesting to see on the chart of the 4900 put is the increase in the IV of the out of the money put. Like at the lower end of this chart, this is the price of the option, and this is the plot of the IV. You can see that the IV readings have been going up fairly steadily all across August. When the IV goes up in an out of the money strike, it's always an indication that the markets or the traders in the market, particularly the smartest set, are actually taking a view that the market could be heading towards those regions. So here we were at the start of August, well above 5,000, and here is your IV build-up in the 4900 put, which was out of the money. I've not shown you the OI here, but we also saw a good build-up in OI. So positions were getting built, the implied volatility was going up. That clearly indicated that there was demand for these puts, and that could happen only because people felt that the price of this option would move up, which is an indication that the price of the index would actually go down towards 4900. And we did see that it went well below 4900 also. So everybody who bought this cheap at the start of the month, this was priced somewhere around, let's say, 40 rupees. Later on in the middle of the month, this was priced at almost 180, 200, 220 rupees. So you made about 4 to 5 times the amount of money that you actually paid for it, and the space of about 15 days.
And this was purely coming from, how much of it came actually from the price movement of the Nifty?
The price of the option will always clearly outpace the price change in the Nifty, because there are two elements in an option. One is the intrinsic value, which goes with the price movement, and there is also additionally the time value. The time value is the little bit extra that you get in options. And when implied volatilities actually go up, the extent of the time value, which is like a froth in the whole scenario, that will increase. So you actually get a bigger bang for the buck trading options.
Okay, there's one point here which I wanted to bring on, and which is, like you said, there's a build-up depending on where the professional traders expect the market to move. What happens if the market actually doesn't move towards that range? What if the markets had actually not come down? Would that have had an impact at expiry time? Would we have seen a reverse movement in the markets which couldn't be explained?
No, not that it couldn't be explained. Most certainly. See, everything is about expectation, right? All trades are taken on the basis of expectation. Either you take a long position in futures or short, or you take a position on options. Everything is out of expectation. When expectations don't really come through, it has a more dramatic effect on options than it would have on the futures.
So this is the build-up in the Nifty 4900 put.
Which is out of the money, because the Nifty was trading at about 5100 plus.
So it would just, at expiry, would it just expire? Or would you have seen the cash market?
If it had not gone down, then it would have expired completely worthless.
How would you use Bollinger Bands as a signal to get into your F&O space?
I think, when you're trading, let's say, anything in option side, you're largely focused on volatility. Second, when you're focused on the trend, you're again focused on volatility. An increase in volatility is an indication that there is going to be a trend onset. So if you use Bollinger Bands, like in the chart that I'm showing you here, at the end of July, what you find is that the Bollinger Bands, which were fairly wide apart earlier, is now much sort of narrowed down. And as the trend begins, this is the early part of August, right, where the lows of the previous month break, and as soon as it breaks and the trend sets in, you see that the Bollinger Bands become much wider, indicating to you that the trend is in force right now. And as the trend sets up, the implied volatility reading goes up and everything follows later.
Could it be that you see this expansion in your Bollinger Bands and yet you're not seeing confirmatory signs with the build-up in options in that space? Does that signal anything?
It is possible, but then, I would say that if you do see an expansion in the Bollinger Bands, which says that the trend is coming, and if that gets combined with some sort of signals on your technical chart saying that there is a breakdown, then it would be reasonable to expect that you will see some out of the money options getting a build-up.
Right. Well, we've taken a look at how options can be used in volatile bearish markets by the swing traders. How about investors who are tempted to buy good stocks as long-term investments? Take a stock like SBI or ICICI Bank. Now, of course, they did make new 52-week lows in the month of August. Take SBI. So agree that the results were weak and it fell post the numbers. And we've also had talk on one of our earlier shows showing that it has been in a bearish channel for a long time. But would long-term chartists say something different for a stock like this? And how would one use technicals and F&O markets to play a stock like this?
Well, there are two ways to do this. One is you use the futures as a simple, let's say, substitute for the stock, in which case you are just playing the downside of the stock. So if you see a chart of maybe State Bank, which I'm showing you here, at the end of July, during July we had seen a nice upside rally. And at the end of July, it actually broke down from there, breaking the lows or the expiry day periods of this particular contract. So it gave you a signal. And as we see, July OI, which I've got on here, has been fairly steady, not much of a build-up. But then as we move into August and the downtrend actually takes hold, we see that there is a gradual increase in the OI. So if you are using futures, then it's just a plain shorting of futures. But if you combine these two things, that you have a rally which got